Hello, everybody. Brian here from quantlabs.net. It is 1:08 a.m., May 15th. This article, two articles here, should put you on edge. The first one is from BNN Bloomberg.ca. Just do a search on these headlines. Stock traders are nonchalant about U.S. being on cusp of default. Now, a lot of these can be hyperbole, but it's getting worse out there as the politics between the Democrats and the Republicans are just getting worse and worse. So let's get on with the articles. As I said, it's found on Bloomberg. Debt ceiling standoff in Congress has the U.S. at risk of being unable to pay its bills as soon as June 1st. You think stock market investors would be anxious about the uncertainty, but you're wrong. Uh, while hedging activity picks up, there are few signs of panic. Expectations, price swings in stocks, most sensitive to government default. S&P 500 index slid 0.3%. NASDAQ index rally 0.6. Measure of market risk, the CBOE volatility index dipped back to a level of 17. So a lot of people are saying that this VIX is wrong, not to be trusted anymore. It's not reliable. The risk is real, Janet Yellen said on Friday. U.S. will have to default on some obligation. If Congress, and they always blame it on Congress. Well, she's a Democrat. What would you expect? If Congress doesn't raise the debt limit, it's just equity investors don't seem to care. Uh, it's like kicking a man who's already down, said Adam Phillips, director of EP Wealth Advisor. Depending upon what happens with the debt ceiling, we could see additional fiscal drag in addition to monetary policy. Eventually need to be reflected in stock valuations because it's not showing up yet. What I've seen, everything's going flat. The markets are more down than up, but everything, a lot of stuff is up. I think only maybe prior week there was one day of trading which was worthwhile, and that was it. Bond market investors are high on alert. Cost of default swap, insuring treasuries against default is higher than contracts of the bonds of countries like Greece and Brazil. Oh, that's pretty bad. Um, okay. Things are more complacent in the stock market. Basket of companies compiled by Citigroup says rely most on the government, aerospace and defense like Boeing and Raytheon. They both declined 1.8%, not far from the S&P 0.9% loss. Gauge of projected price swings in the iShare of U.S. aerospace and defense ETF, Spider Aerospace and Defense ETF in the next 30 days is hovering at the bottom quantile. I have two observations data compiled by Citigroup. Some market vets warn that if calm before the storm, I think that's what I'm seeing. Since protection against a massive drop is cheap, people are taking precaution against the unthinkable, pushing the relative cost to put options last week to the highest in a year. So the last time this happened was in 2011. Uh, the government made a deadline for raising the debt ceilings. This is how far back it's gone, 12 years. Bunch of bozos. So there was a U.S. downgrade. VIX remains sanguine. Escalation of the debt ceiling drama sent swaps spiking. The VIX did jump up to 48, and the S&P stripped the U.S. of its AAA rating. S&P didn't bottom until 2 months after the debt ceiling agreement was struck. Confluence of factors from our European debt crisis to a U.S. credit downgrade turned the 2011 ceiling impasse into a full-fledged rout. It isn't a risk now, but this market is facing its own set of challenges. U.S. economy is potentially approaching a recession. These idiots, including Bloomberg, we are in a recession. It's a recession-like environment. Then the dumb idiot politicians will argue about the definition of it. Doesn't really help anybody. Um, After the Federal Reserve most aggressive monetary tightening campaign in a generation, crisis in the banking system is still simmering. Yes, it is. 18.1 times profit S&P is trading a valuation multiple that's above its average over the past 10 years. Should the valuations moderate and fall, DIP may open a buying opportunity, assuming debt ceiling compromise is reached. What these analysts said. Real risk here's not exactly the default in itself financial ramifications. It's what does further to strike at and or crack or break ultimate consumer confidence and economic spirit. Uncertainty and anxiety leading up to it is going to further exasperate what is going on in the banking system and unwillingness to lend credit. That's already happening. These are so just awesome geniuses, I gotta say. Okay, next article. Now we're going over to the one of the more questionable crypto media sites. This one's at cointelegraph.com. Significant risk of Treasury running out of funds soon report. So the Congressional Budget Office has predicted the U.S. government annual deficits will nearly double over the next decade. Don't forget there's the interest to pay all this as well. I think it's currently at 7%. May go up to 15%. That's just as much as probably the U.S. military budget, as well as the entitlements, will have to get cut or something's going to have to happen. U.S. government faces significant risk of no longer meeting all of its obligations. According to a May 12th published by the U.S. Congressional Budget Office, risk of U.S. debt defaulting on its debt in the near future stems from reaching its statutory debt limits of 31.4 trillion on January 19th. That's awesome that they are so beyond careless and not caring about this. Um, the way it's looking with the U.S. government and who's voting them in, these bums really, uh, there's a real problem there. And it's going to be a major trickle effect throughout the world if this happens in terms of a default. CBO predicts that the debt limit remains unchanged. U.S. government could be in hot water as early as June. That's only 2 weeks away. Um, it was emphasized the outcome of the ongoing Supreme Court case regarding the cancellation of outstanding debt, student debt, loan debt, could have significant influence on the total revenue of 2023. Wow. Um, it was emphasized the outcome of the oh, a shortfall in tax receipts recorded through April was also noted as having the potential to contribute to a larger deficit than initially predicted. So they also have lower tax base, probably because everyone's leaving, giving up their citizenship. But you know how they respond. It used to take a couple of weeks to get that appointment made to cancel your citizenship. Now it takes a couple of years. So now you're basically forced to continue to file your taxes and be responsible for no matter where you live until you can renounce your citizenship, which is again why one of the reasons not helping why their tax base is declining. Based on projected data, CBO does not expect a decrease in the deficit anytime soon. What don't they get? It's predicted that the annual deficit will nearly double over the next decade, reaching 2.7 trillion. So you're going to overspend 2.7 trillion per year at when the debt is already in total at 31 trillion. What kind of morons are these? CBO predicts that 2023 will witness the highest level of national debt ever documented. It's like they don't care. Wow. As a result, these deficits debt held by the public also increased the CBO's projection from 98% of GDP at the end of the year to 119% by the end of 2033, which would be the highest level of U.S. debt ever recorded. Don't know what to say. Anyways, you want to know more? I'd say you want to protect your wealth. Go to quantlabs.net/banking, get yourself a couple of videos and all that fin stuff and learn how to do it. Thanks for listening. Again, that's quantlabs.net/banking. Over and out.